It's going to get worse. Inflation's here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. And gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no, if you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large, long-term investments. Well, that's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer is as the yield to maturity on the 10-year note goes up, that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield to maturity in the 10-year note goes down, then that weakens the dollar, and the dollar price of gold goes up because a weaker dollar means a higher dollar price for gold. So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury notes. But here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971. And I don't have to go through all that data, but that's how I think about it. And you're like, well, Jim, why 1971? Why not before that? And of course, 1971, it was when Nixon stopped redeeming dollars for gold. Americans couldn't even own gold in 1971. It was contraband. It was like drugs or machine guns or something. But foreign trading partners could redeem dollars for gold up until 1971. And then Nixon said no more. And then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. We've gone back to the 1920s or earlier through most of the 19th century. For the United States, in sterling, I think it was $4.75. It could be off a little bit on that, but four pounds and change. And as late as World War I, say 1913, if you were a Brit and you were getting on the steamer from London to, at the time Bombay, today Mumbai, you took a purse of British sovereigns. British sovereign is about 8 grams, a little bit less. It's not an ounce, it's a quarter ounce, because an ounce is almost too much. Even today, what are you going to do with a 1 ounce coin that's worth almost $2,000? You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be like a $500 bill. So it's still a significant amount of money. But you could get on the steamer in Southampton and get off in Bombay at the time, and it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan or all around the world. So gold was actually money. So it wasn't a question of, what's the exchange rate? It was, the gold was the money, and people thought about it by weight. They said, a sovereign, that's 8 grams of gold. So that's worth, that'll get you whatever. So, and that was true throughout history. And so it's really only since 1971, when we decoupled completely in terms of an exchange rate, that you have to think about, what's the dollar price of gold? Because it's not fixed. But okay, well, what happened to the memory? What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it actually took about 75 years. So it began in 1914. 1914 was the outbreak of World War I. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need gold to pay for the war, to try to win the war. Well, it didn't matter if you're Germany, UK, or whoever. And remember, the United States was neutral. The United States did not get in the war until 1917. The war started in 1914. So for those first 2.5 years, New York was a money center to all of Europe, to all the belligerents. So everyone scrambled for gold. So if you were a citizen, they asked you to bring your gold to the bank, and they gave you paper money. But people did it out of a patriotic. It's existential. War is not a normal market. If you lose the war, you got bigger problems than your gold. And so people put the gold in the banks. What did the banks do? they melted it down and made 400-ounce bars. And they said, don't worry, your money's backed by the gold, but keep using that paper money, but it's redeemable for gold. But oh, by the way, they're 400-ounce bars. Nobody walks around with a 400-ounce bar in her purse. I'm sure you've seen one, and I have as well. They're heavy. They weigh about 35 pounds. You don't walk around with them. So all of a sudden, the gold was still there, and the paper money was backed by gold in theory, but the gold had disappeared into the banks. That's step one. Step two, and this happened in the 1930s, the central banks took the gold from the commercial banks. So first, the commercial banks took the gold from the people. Then the central banks took the gold from the commercial banks, and the Federal Reserve System told all the banks, hey, send your gold to the regional Federal Reserve Bank. And of course, most of it went to the Federal Reserve Bank in New York. So now it's not even in the banks anymore, right? But you're still walking around thinking your paper money is somehow attached to gold, but people haven't seen gold for a while, unless you're a collector. Step three, the United States Treasury and the finance ministries took it from the central bank. In 1934, the United States Treasury seized the gold of the Federal Reserve System. Bearing in mind, the Federal Reserve System is privately owned. And they gave them a gold certificate. And you go to the Federal Reserve System website today and hunt around a little bit on the links and find the balance sheet of the Federal Reserve, and it's there. And look in the assets, and the first line item is gold certificate, and it's valued at $11 billion. But that's because they value the gold at $42 an ounce. And I've revalued it, the answer is that today's market, that 11 billion is actually worth 470 billion. So the Fed has a hidden asset of 450 odd billion that's not on the balance sheet, represented by a gold certificate. But it's not the gold. The Treasury has the gold. And by the way, where do we keep our gold? I'm talking about the United States. The Treasury owns the gold. The Fed has a paper certificate. The gold is on two Army bases, West Point and Fort Knox. So I would say the Army has the gold. Gold has gone from citizens walking around having it in your purse, to commercial banks, to central banks, to finance ministries, held on an Army base. It's still there. The gold didn't disappear, but nobody talks about it, and everyone pretends it's not money. But of course it's money. But meanwhile, what's happened to the civilian population, the citizens? We stopped talking about it. We stopped saying it. We stopped learning about it. I remind people, just showing my age, but I got a graduate degree in international economics, and I was class of 74. But that was the year the IMF demonetized gold. But I was the last class that was taught gold in an academic setting as a monetary asset. If you're younger than I am and you know anything about gold, you're either self-taught or you went to mining college, because they just stopped teaching it. So now we have two generations of scholars who never learned a thing about gold. So they hid it, they took it, they buried it, they stopped teaching it, they stopped talking about it, and they pretended it's not there. Meanwhile, it is there. And Russia is a good example of someone who takes it seriously. In the US, we still have our 8,000 tons, 8,133 tons. We haven't given it away. We haven't sold any gold since 1980, by the way. We got the British to do it. We got everyone else to do our dirty work. The British sold more than half, seriously, the British sold more than half their gold. The Swiss sold 1,000 tons. The IMF sold 400 tons in 2010. That was the last significant sale by a monetary institution. Australia sold most of theirs. Canada sold most of theirs. If I were one of these other countries, I would say to the U.S., hey, why don't you sell some of your gold? But the U.S. doesn't. We haven't sold it an ounce since 1980. This is not over. There's been a little bit of a sigh of relief. Stock market rallied a little bit toward the end of beginning of April. And okay, that's a normal reaction. But any thought that the problem's been solved, the bailout's complete, you're not going to hear more, is just not true. There's more coming. Get ready for it. I can't tell you. I'm not going to pick a specific name, and we all know the names of the big banks that might be in distress. Is Deutsche Bank or Barclays or HSBC, Santander. I'm not picking on any of them. I'm just saying that there are more dominoes waiting to fall. The really interesting part about this, and again, we can come back to the specifics, is that the dominoes falling is a good metaphor. It's, if you got 100 dominoes, you knock the first one, they're all going to fall. That's just physics. So how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between two dominoes, and this one hits the wall and this one's still standing. But that's the bailout. But the problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question that I'm wrestling with. Are we now at the point where the needed bailout is bigger than the capacity of the central banks? That they've pulled all the rabbits out of the hat, played all their cards. And again, this goes back to what I did say about the Silicon Valley Bank rescue. It is the biggest bailout in history, and I can explain why. But if that's the case, and what else do they have? And then, so now we're dangerously close to the point where, as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. It's the dollar. The crisis is the dollar itself, and the euro, goes along with that. And then that's the crisis. And there's no way to bail out a dollar crisis with dollars, because you're just pumping more of what people have lost confidence in. And then, then where do you go? And there are good answers to that. We've seen it again. We've seen it all before, but you have to kind of take the timeline out to 1,000 years, or the 1350s with the failure of the Bardi and Peruzzi banks in Florence, to see how these things can really play out. So this is big. It's not over. The regulators will attempt more bailouts, but we're at the point where I think you can start to question the regulators themselves. Brazil, Mexico, Argentina, the Latin American debt crisis, broadly defined in the early 1980s. That played out, the intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. We were moving $8 billion out of Silicon Valley Bank, and we got the wire transfer request in, but we didn't know, because you get to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We didn't end up moving the money, but there was about a 48-hour period there from Friday to Sunday when no one knew that the wires had been completed. The recipients didn't have them. It was just in limbo, and it worked out. And they talked about, all these small entrepreneurs and startups. They got 100 employees and $5 million in working capital, and that money's gone, and they're all going to fail. There was something to that, but the fact is, you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. So, but yeah, you can. In the old days, you had to line up around the block, and maybe it was raining. You're standing there in the rain, waiting for your turn to get up to the tower. Now you can be in line at McDonald's, with your cell phone, and just a couple hits, QR code, and boom, $10 million is gone. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money out, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So the time frame is becoming more compressed because of technology. You're exactly right about that, which means that the response function has to be equally compressed, or else you are going to have all the consequences of an honest to goodness global financial crisis. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank, and they issued a press release, and they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured. No worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. And it's a receivership certificate. And they said, hang on to them. In effect, we're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years. And they were very efficient. I worked with them at the time. We were in their offices when we were sitting on boxes because they didn't even have furniture, but they were doing deals. So they had the right attitude, but that took 2 years. So, and that was it. Well, that's when I call the billionaire crybabies came out and forced, Bill Ackman, all these guys, oh, you got to save us, I was like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now, here's something that very few people, say almost nobody knew at the time, except the management, although they seem to be asleep at the switch. everyone's like, yeah, startups, venture capital. There's a lot of truth to that. 97% of the deposits at Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's a way, if you're looking at these big banks or any institution or your own savings institution, to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years, but they're working on it. Wind turbines, other sustainable fuel alternatives, et cetera. Again, I'm not do that if you like, if that's your field of research, but so much as is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were, by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses, and by the way, we are in an election cycle here in the United States, but from the Greenies, who are extremely powerful. Sunday night at 6 o'clock, by the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. 6 p.m. Sunday, November 12th, they came out on, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse, and then the week after that was something else. But they always announce the collapse on Friday, and they announce the relief on Sunday, so they have the weekend to work on it. But you got to be careful about 3-day weekends. Easter, Easter is an example. If you have underwater bonds, U.S. government securities, treasuries or certain mortgages, you can ship them to us. We will give you a loan at par value. We'll give you cash equal to par value, even though the loans are only worth 80 to 85 cents on the dollar, because interest rates have been going up for over a year. The value of the bonds goes down. That's bond math 101. Rates up, bonds down, prices down. Rates go down, the prices go up. Well, the rates have been going up, so the prices are down. So these bonds are worth 80, 85 cents on the dollar. But here's the Fed saying, we'll give you 100 cents on the dollar for your 85-cent bond on a one-year loan. So the loan was important because it means they didn't actually sell them. It was collateral for a loan, except you're under collateralized. And the Fed's like, okay. I said, I have a 14-year-old car that my dealer says he won't give me any money for. So I sent a tweet out. I said, hey, Fed, would you give me the $70,000 I paid for it? It's not worth anything, but, let's get back to par here. That's what the Fed was doing for the entire system. But the thing is, Brian, you're talking about multiple trillions of dollars of bonds that fit that description I just gave you. Now, the banks are kind of saying, oh, that's good. That's a good deal. I'll take that. I'll do that myself. Here's something under collateralized. You give me the cash on a one-year low interest rate loan. And now, in theory, I've got all the cash I need to pay depositors if they were taking the money out. But better yet, I don't have to record the loss.
Small ebook, big impact, the wealth tree. The only 4 ways that will make you financially free forever.
Global economy is the big topic. That's what we all care about most. But financial markets can come up with their own narratives and go their own way, at least for a while. So they're not in sync. They will be in sync eventually, but not always right away. A lot of times the financial markets get ahead of themselves and then they wake up to reality and they, crash, correct down. So there's a little bit of that going on. But in terms of global economy, I think your use of the word global is very much on point, because we are going into, or may already be in, a global recession. Now that's rare. It's rare when, China, Japan, US, Germany, they're all in recession at the same time. But that's what's unfolding. That's a big deal. Well, for obvious reasons, because it affects basically everyone. But there's no life preserver. There's no. It's not like China's going to pull us all out of it with cheap exports, or Japan's going to put the pedal to the metal in terms of fixed asset investment, et cetera. So that's a really bad sign. I mean, and just to be very specific, we just saw U.S. fourth quarter GDP grew at a 2.9% annualized rate. People are like, yeah, it's pretty good. And it's not good by post 1980 standards. It's not good at all by post World War II standards, but post 2008, yeah, that's not bad. Again, you have to disaggregate it and you look at what grew. It was inventories were a big contributor, and net exports were a big contributor, and fixed asset investment in particular. There was a big load of aircraft orders for Boeing, which is notoriously lumpy. They'll have a big month, blowout month, and then nothing for a couple of months, not nothing, but something very low. So when you look at that, inventories are counted as part of GDP, of course, but it's not necessarily a good thing. If inventories are piling up, it means retailers are not buying. And this kind of goes back to the whole supply chain breakdown of a year ago. That's what my book Sold Out was about. So you go back to, let's say, the spring of 2022. The supply chain had completely fallen apart. And if you were a purchasing manager and you were saying to yourself, okay, we're kind of coming out of COVID, we're going to start growing, but the supply chain is broken. So instead of ordering one, container, I'm going to order 3 containers because maybe one will get through, through the bottlenecks. I only want one, but I'm going to order 3 and hope for the best. What happened was a lot of the stuff was alleviated, not for good reasons, not really for logistical reasons, but because the consumer slowed down a lot beginning in June, partly in reaction to the Fed starting to hike rates in March of 2022, and then here come the 3 containers. So at the exact moment when demand destruction is kicking in, your inventory is going to the rafters. So what do retailers do, or wholesalers for that matter? But retailers, they slash prices. That 2-for-1 sales. Because inventories are a nightmare for retailers for obvious reasons. Number one, you have to finance them, so they eat up working capital. It could be cash, but now you got a bunch of stuff in the back office. And number two, it just takes up space. I mean, insurance costs and other costs like that. But the other thing people kind of underestimate is that, like, fashion stuff goes out of fashion. Last spring's styles are not next spring's styles. You still got last spring stuff. Good luck. We're getting close to spring, so you're dumping that stuff. Consumer electronics, you got an iPhone 13. Well, everybody wants an iPhone 14, whatever. I mean, you take the point. So piling up inventories is a very unhealthy sign. It means the retail sector is drying up, demand destruction is kicking in, costs are going up because you got to finance all this stuff, and your profit margins are going down. So I don't take a lot of comfort from that. But the other thing, to the extent you can disaggregate monthly data, and there's a lot of monthly data, 2.9% annualized for the quarter, but it really slowed down in December. Christmas was a disaster. I mean, people bought stuff for Christmas, but way below expectations. And again, it goes back to piling up the inventory at the worst possible time. So it looks like the U.S. is going into 2023. Possibly recession started in December. If not, we expect it to start soon. But you're seeing the same thing in Europe now. Europe got a break with the weather. Obviously there's a war going on, so that's a big factor. But, and natural gas prices skyrocketed and oil prices skyrocketed again in mid 2022. They've come down, but it doesn't mean that, all is well or they're out of the woods. And there are other things going on. China is a basket case. They went from zero COVID. It was bad public policy and bad health policy, but they did it anyway. So they flipped almost on a dime. So they just turned on a dime and said, okay, let it rip. The policy, let it rip. Okay, let everyone get infected and we'll do the best we can. One of the ways you get through it is by letting it rip, and you develop what's called herd immunity. And that's what worked in North America and Europe. But the other difference between China and Europe and the U.S. is that they don't have the healthcare system to deal with it. Our healthcare system, which is pretty good, was strained. Same thing in Europe. China has nowhere near the ICU units, the oxygen, the treatments, the professionals, the nurses and doctors, not even close. And when you get out to the village level, which is where most of the people still live, believe it or not, they often have nothing. But that is hurting the economy as much as the zero COVID. They had no good ways out. I'm not saying one's better than the other. They're both awful, but But you still have a lot of things that are not COVID. The real estate collapse, the excessive debt, the demographic decline, just the impact of top-down management when you can't possibly get everything right, and decoupling from the U.S. and the U.S. cutting off, high-tech exports to China, including third country exports where they're relying on U.S. licenses or equipment. So China's in a deep hole, probably in a recession. Japan, same thing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got three Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling three different stories and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. And I guess I'm a storyteller here, but what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They probably are at the so-called terminal rate. They just don't know it. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot to say that there could be a rate cut. It won't be in April, but, rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes and then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow. So maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about this. I'd rather be the U.S. than China. China's in even worse shape for different reasons. It's not so much interest rate policy, although they're subject to global interest rate policy and exchange rates coming from the Fed. But you can see it in real estate. It's a full-scale collapse. They're propping it up, but the buyers aren't interested. In other words, the Chinese government is telling the banks to lend money to real estate developers who can't finish housing. Well, that sounds good. It's like, okay, here's some money, finish the housing. But the buyers are not flocking in. The buyers have been burned. They're shying away from that asset class. They want to increase cash. They're looking at other asset classes. They don't have a lot of choices because China has very strict capital controls. They're trying to get their money out by means legal and illegal. They're buying gold when they can. But as I say, they may not have a lot of choices, but even money in the bank looks pretty good compared to what's going on in real estate. The problem is too big. The bubble is too large. It's going on for too long. We don't hear about it the same way we did about the Japanese real estate bubble in 1989, 1990. That was an epic crash. Japan has still not recovered. I remember in the 90s, early 2000s, they talked about the lost decade. Well, try 3 lost decades. That's going into a 4th. That's Japan, 8 or I've lost count, actually 8 or 9 recessions since 1989, but it's really just one long depression. That's the way to understand the Japanese economy. China's going into something like that. We don't hear much about it because they're not transparent. They lie about their numbers. You need to look at private sources and use other analytic tools to understand what's going on there. But they've got drops in consumption, industrial output, real estate's collapsing. Their price indices are collapsing. All this fear of inflation. It's been around. It's real, but it's now turning around very quickly. And you can see that in China. China's going through something that the world has never seen. They're going to lose 600 million people in the next 50 to 70 years. This is a demographic implosion. This is worse than the Black Death. Of course, the Black Death killed somewhere between a third and half the population of Europe in the 14th century. It was a good time for labor, by the way. The labor was so scarce that returns to labor went up versus returns to capital because there weren't enough workers. But that's the only thing that can come close. Even the Spanish flu of 1919 killed about, no one's certain of the number, but between 100 million and maybe over 200 million people. The 30 Years' War was certainly, in the early 17th century, was certainly highly destructive. But what's going on in China now is worse than any of those things. It has to do with simple demographic math. The key number is 2.1. Two people have to produce 2.1 children. A man and a woman, or you can say per woman if you want, have to produce 2.1 children to keep the population constant. Why not two? Why not two producing two? The answer is infant mortality and those who don't make it to adulthood and can continue the repopulation of the planet, if you will. But they're not even close to that. They're well below two. And by the way, so is the rest of the world. So is Australia and the US and Western Europe and a lot of other places. This is a global phenomenon, but it's particularly acute in China. It may be the case that China's replacement rate is or birth rate is actually 1. It has to be 2.1 to maintain. It could be 1 or lower. This is a demographic implosion unlike anything anyone's ever seen. It also has a dynamic. You can't reverse it very quickly. It feeds on itself, as I was talking about inflation earlier. So this is going to continue for 50 to 75 years. They're going to lose 600 million people. There are a lot of definitions of GDP, 4 or 5 part definition. There are more complex calculations, but there's one really simple definition. It only has 2 factors: population and productivity. How many people are working and how productive are they? That's nominal GDP. That's one definition of gross GDP or nominal GDP. Well, if your population is dropping from 1.4 billion to 800 million, you're losing 600 million people. And then what about productivity? Well, the other thing that's going on is China's population is aging very quickly. So you get a population of set people in the 70s, 80s, and 90s with very large amounts of cognitive decline, dementia. Obviously, there's no productivity there, but it's worse than that because then you look at the shrinking population between the ages of 25 and 54. It's called their prime working age. More and more of those people are going to have to be involved in elder care. They're going to have to be basically caretakers or caregivers for the older population I described. A very worthy job, but not one that lends itself to productivity gains. Bathing hasn't changed in about 5,000 years. Robots don't do baths. The only real innovation in bathing in between 1870 and 1940, we did see the rise of indoor plumbing and hot water. That's good. I enjoy both, but that's it. I can't think of any other bathing innovations in the last several millennia. So if you have a shrinking working age population, a rising older population, high degree of cognitive decline, and a big slice of the working age population having to provide elder care or be caregivers for the older population, tell me where your industrial output's coming from. Tell me where your productivity is coming from. And sorry if I mentioned this already, but 50% of the water in China is poisoned because of, just their industrial practices. If you're a gold miner in Australia, I invest in gold mines around the world. I know that places like Canada, the US, and Australia, if you use cyanide to leach the gold, and that's a very common technique, you have to account for every, microgram. Whatever you put in, you got to take out, weigh it, dispose of it properly. In China, they just dump it into the rivers, and so the rivers are poisoned. So China is an economic, demographic, industrial, moral, religious wasteland, and will suffer. It's already in a recession. Just to cut to the chase, again, they lie about their statistics. So here you have the two largest economies in the world, U.S. and China. U.S. is slowly going into what I expect will be a severe recession. China is in a century-long decline, unlike one that the world has ever seen. That could eventually lead to social unrest and a regime change, but let's not count on that in the short run. Just expect China to shrink and become more autarkic, decouple from the Western world, and certainly not be a source of growth. Taiwan Semiconductor Manufacturing Company, the largest and most sophisticated semiconductor manufacturing in the world. And semiconductors are in everything. It's not just computers. There are 1,400 semiconductors in an automobile. There's a semiconductor or more in your dishwasher, your refrigerator, your washing machine. They're everywhere. Internet of Things. We all understand that. So TSMC, based in Taiwan. The United States has a military doctrine called the broken nest theory. And what it says is that if China, well, it comes from a Chinese proverb, ironically, and it says, if the nest is broken, how can the eggs survive? And what it means is that if China invades Taiwan, and I'm not forecasting an invasion, could happen though, we or the Taiwanese will very quickly destroy all the semiconductor manufacturers in Taiwan. We'll just blow them up. And China won't get anything. They'll have the broken nest. Taiwan Semiconductor knows this. They talk to the U.S. intelligence and military. People hear the government say, the economy's fine, or, unemployment's near an all-time low, which is actually statistically is true. And they kind of nod and go, yeah, it's all good. And then reality is the stuff that hits you in the head like a 2x4. The propaganda is positive. We can talk about that in a little more detail. The reality is harsh. And reality wins. There's a very good book on this by Robert Shiller, Nobel Prize winning economist at Yale University. I'm not a huge fan of your garden variety PhD economists, but there are some good ones out there, and he's one of them. He wrote a book about, 2 years ago, maybe a little bit less, called Narrative Economics. He said, we got all the models and Phillips curve and wealth effect and various, quantity theory of money, and, some have a place, some are more valuable than others. But don't underestimate the power of a narrative. A narrative is a story. It's basically it's a fancy name for a story, but a story that persists, that grows. And interestingly, in epidemiology, of course, we've just come through a pandemic. There's a model called the SEIR model that stands for susceptible. Are you susceptible to a virus? E for exposed. Are you exposed to it? I, are you infected? Did you get it? And R, did you recover? The difference between I and R are people who died. But it's a model, and it's mathematically based, and it's empirically validated of how viruses spread exponentially. And you can also use it to forecast how a virus is going to go. Well, what Shiller did, he took that model, moved it over to economics, and took a narrative kind of like a virus, not in a negative sense, but just as something that spreads. And it can be very powerful, and then eventually may die out or reverse, but it can be powerful in the meantime. That much I knew, but what I learned from the book that I hadn't really thought about is that narratives don't have to be true. They can be true, and they can be very powerful, but a narrative can be false and still be powerful. If it's the self-fulfilling prophecy, if enough people believe it, it sort of becomes the reality to some extent, even if it's based on false premises. He gives an example during the Great Depression. The Great Depression really was two technical recessions, but there was a period from 1929 to 1933, election of Franklin Delano Roosevelt. And then there was another period from 1933 to 1937. The 37 and 1940 part we leave aside for this purpose. But during the first part of the Great Depression, unemployment was high, output was dropping, trade was dropping. It was a very, very bad time, no doubt about it. But not everybody was out of work. Not everybody was poor. There were a lot of people with a lot of money at the time. But it was felt that being ostentatious was poor form. It's like, okay, I'm lucky I have a job, I've got some money, but I'm not going to buy a new car, buy a big house, or flash it around or whatever, because it's really not considerate of all the people who actually have fallen on hard times. Well, that was the narrative, but it's the worst possible economic advice, because is precisely the fact that people with the money should keep spending that kind of can boost the economy out of a depression. So by people saying, well, even though I have the money, I'm not going to spend it because it's poor form, we're actually prolonging the Great Depression. Now, when FDR came along, he was elected in 1933, became president in 1934, the psychology turned 180 degrees, and all of a sudden, the Democratic campaign song was "Happy Days Are Here Again," and FDR seemed to solve the banking crisis and so forth. And all of a sudden, it became okay to spend money. Well, in the middle of the Great Depression, 1934 to 1936, those were some of the strongest years ever for the stock market. And unemployment did come down a lot. Now, the problem is it came down from like 25% to 15%. Well, 15% is still, painfully high, but it was a big move in the right direction. So he describes how the narrative flipped from don't spend money, it's poor form, to, go spend money and help the economy. None of that is taught in business school. It's not taught in economics. It can be modeled using this epidemiology model, but it doesn't fit into any of the standard macroeconomic models, but it's powerful stuff. And so today what's going on is that the White House is trying to push a narrative, and they're failing badly. But they'll say, if you listen to deliberations among White House officials, some of the stuff leaks to the press, and I know some of these people. It's like the economy's great, unemployment's really low. We've created all these jobs since the pandemic, but we're doing a really bad job of messaging. The point is, they're inside the White House. They're frustrated that the positive economic story is not getting out. The correct analysis is that there is no positive economic story. The economy is in terrible shape. The problem is not the messaging, it's the message. And this is where I say the propaganda from the White House that things are great is at odds with the reality, which is things are not great. Let me give you some specific data points, because as I say, I don't like to make statements like this without backing it up. Number one, the inflation was going up long before the war in Ukraine started. So if everything is great until February 27th, and then Russia invades, and then all of a sudden the inflation goes up. All right, let's talk about it. But that's not true. This inflation goes back to late 2021. It was persistent in the fall. We all remember the Fed and the Treasury saying transitory, transitory, transitory. And then finally, I think Jay Powell was testifying before Congress. He said, it's time to retire the word transitory. So that was his way of throwing in the towel. And Janet Yellen admitted she was mistaken also. So it predates the war, number one. Number two, energy prices are going up because there's a war with Russia. Well, I wonder why that is. Well, the reason is not because Putin invaded Ukraine, it's because the U.S. counterattacked with financial sanctions. Now, bear in mind, go back to January 21st, 2021, when Biden was sworn in as president, and then went back to the White House. What was the first thing he did? He closed the Keystone XL pipeline. This is a pipeline that would bring oil from Alberta, Canada, into the United States, where it would connect at a hub. I believe it's in Kansas, but somewhere in the central United States. And then the hub distributes it to the entire country. So he shut down that pipeline, which curtailed the supply of oil from Canada. Then ended new leasing, oil and gas exploration leasing of federal lands, handicapped the fracking industry, took a number of other steps using environmental tools, climate alarm, government subsidies, et cetera, to basically, to the extent possible, shut down the U.S. energy industry as much as possible. Now, you can't shut down completely, of course, but everything happens at the margin. And then we end up with oil prices doubling or tripling, really, from $40 to $120 in under a year, which is comparable to what happened in 1973 with the Arab oil embargo. And then Biden wakes up and says, guess we need more oil. And he wants to reopen leasing. I said they shut it down. They did, but he wants to reopen it. He's begging Saudi Arabia to pump more. Saudi Arabia is kind of not returning his phone calls. He's begging Venezuela to pump more. Oh, great. The greatest pariah dictator in the Western Hemisphere, and we're begging him for oil. So why don't we drill our own oil? Because we were a net exporter up until 2021, and then Biden came in, and we lost that edge and became a net importer, including recently buying oil from Russia. They curtailed that for political reasons, but that's kind of where we got to. So you wonder why the price of energy is going up. In other words, this damage was self-inflicted, but don't be misled by the headlines, because they're, again, this narrative, but they're not actually doing it. So the point being, the price increase and the inflation in the U.S. has very little to do with Putin, and everything to do with the U.S. handicapping its own energy industry begging dictators for oil, and the influence of the climate alarmists. And by the way, that whole crowd want higher gas prices. They want gas to be $7, $8, $9 a gallon because they expect that will accelerate the transfer to electric vehicles and make the electric vehicle more attractive relative to the internal combustion engine. Now, that's another fantasy. It won't happen. We don't have time to go through all the physics of it. And, output of energy by weight, gasoline compared to batteries and the pollution of batteries, and the fact that, we don't have the charging stations. And even if we did, where's that electricity coming from? Oh, coal. It will never happen. But meanwhile, they're destroying the U.S. economy in pursuit of an ideological point that will never actually happen. Another example of propaganda versus reality. Narratives are powerful, but reality is more powerful. Powell did not say, we're going to raise rates until core PC is 2%. He didn't say that. What he said was, we're going to raise rates until it's acting in a restrictive way on inflation, and inflation will come down on its own because rates will be high enough to cause that. At which point we, the Fed, will pause. And you say, well, when are you going to cut rates? He was like, the pause could be a year. So you're talking, forget this Fed pivot nonsense. I mean, you're talking 2024, if then, before they cut rates. But in the meantime, so they've got to get rates high enough. So they're going to go, 75 basis points in November. December, who knows? We'll know closer to the date. It'll either be 50 or 75. Some talk about 50, but it doesn't matter. I mean, it's going up. Probably going to go up. I have the calendar for 2023. There's a meeting February 1st and another one in late March, I think March 22nd. They'll probably raise up both of those. They're going to get rates up to five-ish. At that point, they probably will have achieved the goal of bringing core PCE down, but they will also have destroyed the economy in the process. It's like I remember in Vietnam, the old saying, we had to. This is the latest in a long string of Fed blunders since 1913. Seems to be their specialty, but that's what they're doing. They could at least pause now, or maybe even cut rates. If everything I said is correct, and obviously I think it is, or I wouldn't be saying it, but if we're on the verge of a global liquidity crisis, as revealed by the Eurodollar futures curve and the Treasury yield curve, and negative swap spreads and Treasury bill auctions with the yield to maturity below what the Fed will give you for a phone call, I mean, all those things are happening. That's hard data. And it's a very, very troubling sign, last seen in 2008, by the way, before the Lehman Brothers meltdown. If all that's happening and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? When I talked to my editor about this, go back a year ago, so November 2021, every headline you looked at, website, commentator, supply chain's breaking down. There's no, they couldn't get cream cheese to make cheesecakes at Junior's, the world's most famous cheesecake place, and on and on and on, like a long list. And then last spring was the baby formula shortage, which was serious. I mean, mothers couldn't feed their children, so it was very bad. But I found some really, really interesting research that, because everyone says, well, yeah, COVID messed it up and the war in Ukraine messed it up. Well, that's true, but it didn't start there. This started in 2018 with Trump's tariffs, because I'm not here to debate the tariffs. I actually think the tariffs were a good idea, but that was the start of the supply chain breakdown. Because when Trump put tariffs on, started with appliances, washing machines, refrigerators and stuff, and then solar panels, and then, technology, and then they just kept piling on. But you have to look at what China did in response. The U.S. and Brazil are the two largest exporters of soybeans. China is the world's largest importer of soybeans. Mm-hmm. China was buying all their soybeans from the United States just as a way to kind of make it up a little bit. Like, well, we got to buy the soybeans anyway. Why not buy them from the U.S. to keep the U.S.-China trade deficit under control so it doesn't become too politically toxic? Well, as soon as Trump threw on the tariffs, China retaliated by moving their soybean orders to Brazil, stop buying U.S. soybeans. Well, that's not a phone call. I mean, you're talking about vessels, port facilities, agriculture, trucks. How do you get the soybeans to the ports? How many do you grow? Where's the fertilizer coming from? Et cetera, et cetera. And all those parties, the shippers, the cargo, the insurance companies, there's so many people involved, banks, letters of credit, it's just a lot involved. They don't like short-term relationships. They say, okay, I'll do it. I want a 5-year contract. And China said, okay. So they reconfigured all those transportation lanes to get the soybeans from Brazil. All of a sudden, you're a U.S. soybean grower. You say, well, what do? Well, we start selling them to the Netherlands because the Netherlands needs soybeans too. So now instead of shipping them from like Port of LA to Ningbo and near Shanghai, we're shipping them from Port of Houston to, I don't know, France, or Marseille or someplace, or Rotterdam. So the point being, you completely scrambled all these supply chain relationship, and they break down. It's not that it's the end of the supply chain. So there's nothing new about supply chains. We can document to the Bronze Age. What was new, beginning around 1989, was supply chain science. The combination of vastly improved computing power, artificial intelligence, new algorithms, and more sources of data that could be put together and used by experts to optimize and make the supply chains more efficient. That was new. And it kind of began with the fall of the Berlin Wall and the collapse of the Soviet Union. And, Berlin Wall fell in 1989, Soviet Union dissolved in 1991. I talked to the guy who, this is a worldwide endeavor, but he was probably the single most responsible individual for all the significant developments in the supply chain in the last 30 years. And he said to me, Jim, you have to understand, it took us 30 years to build it. We blew it up in 3 years. It's not going to come back overnight. It's going to take 10 years or more to rebuild it. And what I talk about in the book is supply chain 1.0, which is 1989 to 2019, and then supply chain 2.0, which kind of starts now, but is going to go indefinitely because it's going to take a long time to put this together. It's it's like dropping a vase and it breaks in 1,000 pieces. You can't put it back together. You got to go buy a new vase. And that's what's going on with the supply chain. There will be a supply chain, there always is, but the new supply chain will look very different from what we've just come through, because the whole 30 years of period I'm describing was built on efficiency, lower cost, lower cost, lower cost. It was kind of the Walmart model. So yeah, just-in-time inventory, everyone knows about that, but there's something called cross-docking. That's where a truck pulls up at a warehouse and you unload it, and instead of putting the stuff in the warehouse, you move it to another truck that then goes to a destination. The stuff never goes in the warehouse. Inventories are very expensive. They're costly to finance. You got to move the stuff around. It's called picking. Pick the stuff off the shelf with you. I used to drive a forklift, so I know a little bit about it. And put it on a truck. I used to unload trucks too. So, hey, I've got 7 suppliers. Why don't I cut it down to 3 and do bigger contracts with each one and get lower unit costs? I've got 5 transportation lanes. Why don't I cut that down to 2, get everything to Los Angeles and Seattle, as the case may be, et cetera. And they did it for 3, and they got costs lower, and Walmart and Amazon were the champions of this, but everyone else was doing it. But they missed something. What they missed was that while they were getting those unit costs lower for consumers, there were hidden costs, and the main hidden cost was you were creating greater frailty. This whole system was subject to a massive, massive breakdown. So, what happens if you have 2 suppliers and they both go on strike? What happens if you have 1 port of entry and it's backlogged? What happens if you've got cross-docking in warehouses and there aren't enough trucks? We need 80,000 drivers. Wish they'd hire them instead of these IRS agents. But the point being, it is breaking down all across the board. Now, can it be put back together? Yes, but the biggest difference between 2.0 and 1.0, and this goes by different names. Janet Yellen called it friendshoring, and Macron called it a constellation of nations. I use the term a college of nations, collegial club, if you will. So you'll still have trading partners, you'll still have outsourcing, you'll still have transportation lanes, but it'll be members only. It'll be basically democratic, kind of liberal republics, Western Europe, the EU, of course, US, Canada, Australia, New Zealand, Japan, and some others. India, I would expect to be included. Friendly nations, but China's out. We're decoupling from them. They're decoupling from us. This isn't U.S. driven. The U.S. is participating, but this is what China wants too. Both sides are decoupling as fast as they can. China can develop its own network, maybe Central Asian republics, some Southeast Asian, suppliers and so forth, but they're going to lose customers. Well, most of their customers actually in the United States. We won't buy their stuff and we won't sell them our stuff, particularly high-tech stuff. So the world's going to break, and these new clubs are going to be formed, and there will be trade and there will be transportation lanes, but it'll be much more restrictive. Now, will prices be a little higher? Yes, but it'll be more secure. So the way I describe that, if you buy insurance on your house, or I buy insurance on my house, you don't want your house to burn down. You hope it doesn't. But if it does, you don't think your insurance premiums are a waste of money. Like when you write that check, you're like, that's money well spent. When you pay higher prices for consumer goods, the delta between the old price and the new price is your insurance premium for a more reliable system. And also, there's a big national security component to this. It's going to get worse. Inflation's here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. And gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no, if you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large, long-term investments. Well, that's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer is as the yield to maturity on the 10-year note goes up, that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield to maturity in the 10-year note goes down, then that weakens the dollar, and the dollar price of gold goes up because a weaker dollar means a higher dollar price for gold. So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury notes. But here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971, and I don't have to go through all that data, but that's how I think about it. And you're like, well, Jim, why 1971? Why not before that? And of course, 1971, it was when Nixon stopped redeeming dollars for gold. Americans couldn't even own gold in 1971. It was contraband. It was like drugs or machine guns or something. But foreign trading partners could redeem dollars for gold up until 1971. And then Nixon said no more. And then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. So going back to the 1920s or earlier, through most of the 19th century. For the United States, in sterling, I think it was $4.75. It could be off a little bit on that, but four pounds and change. And as late as World War I, say 1913, if you were a Brit and you were getting on the steamer from London to, at the time Bombay, today Mumbai, you took a purse of British sovereigns. British sovereign is about 8 grams, a little bit less. It's not an ounce; it's a quarter ounce, because an ounce is almost too much. Even today, what are you going to do with a 1 ounce coin that's worth almost $2,000? You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be, like a $500 bill. So it's still a significant amount of money. But you could get on the steamer in Southampton and get off in Bombay at the time, and it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan or all around the world. So gold was actually money. So it wasn't a question of, what's the exchange rate? It was, the gold was the money, and people thought about it by weight. They said, a sovereign, that's 8 grams of gold. So that's worth, that'll get you whatever. So, and that was true throughout history. And so it's really only since 1971 when we decouple completely in terms of an exchange rate, that you have to think about, well, what's the dollar price of gold? Because it's not fixed. But okay, well, what happened to the memory? What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it actually took about 75 years. So it began in 1914. 1914 was the outbreak of World War I. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need gold to pay for the war, to try to win the war. Well, it didn't matter if you're Germany, UK, or whoever. And remember, the United States was neutral. The United States did not get in the war until 1917. The war started in 1914. So for those first 2.5 years, New York was a money center to all of Europe, to all the belligerents. So everyone scrambled for gold. So if you were a citizen, they asked you to bring your gold to the bank, and they gave you paper money. But people did it out of a patriotic. It's existential. War is not a normal market. If you lose the war, you got bigger problems than your gold. And so people put the gold in the banks. What did the banks do? They melted it down and made 400-ounce bars. And they said, don't worry, your money's backed by the gold, but keep using that paper money, but it's redeemable for gold. But oh, by the way, they're 400-ounce bars. Nobody walks around with a 400-ounce bar in her purse. I'm sure you've seen one, and I have as well. They're heavy. They weigh about 35 pounds. You don't walk around with them. So all of a sudden, the gold was still there, and the paper money was backed by gold in theory, but the gold had disappeared into the banks. That's step one. Step two, and this happened in the 1930s, the central banks took the gold from the commercial banks. So first, the commercial banks took the gold from the people. Then the central banks took the gold from the commercial banks, and the Federal Reserve System told all the banks, hey, send your gold to the regional Federal Reserve Bank. And of course, most of it went to the Federal Reserve Bank in New York. So now it's not even in the banks anymore, right? But you're still walking around thinking your paper money is somehow attached to gold, but people haven't seen gold for a while, unless you're a collector. Step three, the United States Treasury and the finance ministries took it from the central bank. In 1934, the United States Treasury seized the gold of the Federal Reserve System. Bearing in mind, the Federal Reserve System is privately owned. And they gave them a gold certificate. And you go to the Federal Reserve System website today and hunt around a little bit on the links and find the balance sheet of the Federal Reserve, and it's there. And look in the assets. And the first line item is gold certificate, and it's valued at $11 billion. But that's because they value the gold at $42 an ounce. And I've revalued it, the answer is that today's market, that 11 billion is actually worth 470 billion. So the Fed has a hidden asset of 450 odd billion that's not on the balance sheet, represented by a gold certificate. But it's not the gold. The Treasury has the gold. And by the way, where do we keep our gold? I'm talking about the United States. The Treasury owns the gold. The Fed has a paper certificate. The gold is on two Army bases, West Point and Fort Knox. So I would say the Army has the gold. Gold has gone from citizens walking around having it in your purse, to commercial banks, to central banks, to finance ministries, held on an Army base. It's still there. The gold didn't disappear, but nobody talks about it, and everyone pretends it's not money. But of course it's money. But meanwhile, what's happened to the civilian population, the citizens? We stopped talking about it. We stopped saying it. We stopped learning about it. I remind people, just showing my age, but I got a graduate degree in international economics, and I was class of 74. But that was the year the IMF demonetized gold. But I was the last class that was taught gold in an academic setting as a monetary asset. If you're younger than I am and you know anything about gold, you're either self-taught or you went to mining college, because they just stopped teaching it. So now we have two generations of scholars who never learned a thing about gold. So they hid it, they took it, they buried it, they stopped teaching it, they stopped talking about it, and they pretended it's not there. Meanwhile, it is there. And Russia is a good example of someone who takes it seriously. In the US, we still have our 8,000 tons, 8,133 tons. We haven't given it away. We haven't sold any gold since 1980, by the way. We got the British to do it. We got everyone else to do our dirty work. The British sold more than half, the British sold more than half their gold. The Swiss sold 1,000 tons. The IMF sold 400 tons in 2010. That was the last significant sale by a monetary institution. Australia sold most of theirs. Canada sold most of theirs. If I were one of these other countries, I would say to the U.S., hey, why don't you sell some of your gold? But the U.S. doesn't. We haven't sold an ounce since 1980. The thing I would point out is that there are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really talking about when we say, gold is up, what we're talking about the dollar price of gold. And I view it as a cross exchange rate. People talk about the dollar, the euro dollar exchange rate. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So there's just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar. But the first great bull market was 1971 to 1980. It lasted 9 years, and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up at just a little under 700%. But in between, you had a bear market from 1980 to 1999. So a long one, almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. And we had a second bear market starting in 2011. Now, I had a very interesting conversation with Jim Rogers. Jim is one of the great commodity traders, money managers of all times. And we were down in Dominican Republic at Casa de Campo. This is around 2014, but the bear market started in 2011, but it really fell off a cliff in 2013. So I said, Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just hit me right between the eyes, and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base, because you need a base, so you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit. Well, we're not overheated at all. I've got gold at I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, and 7,000 first. So there's plenty of room to run, plenty of room for profits. But when I say things like that, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air and for publicity, because I could care less. But if you just took the average, and there are a couple ways to think about it. Just take the average of the two prior bull markets I mentioned. So 71 to 80, 9 years, 2,200%. 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025. And at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. But there are other ways to think about it. Now, I don't know if there'll be a gold standard or not, but I do know that gold will move, the price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is a pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less, you come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price, Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years. It is a moving target. The numbers I gave you are based on current levels, but if you keep printing money, you need a higher price if you want to reference gold and not cause deflation, which they don't. You're going to need a progressively higher price of gold. One thing people forget, they look at the dollar price in absolute dollars. So it went up $100 an ounce, or I expect before long it'll go up $1,000 an ounce a week. But each dollar increase is a smaller percentage increase. So people look at the dollar. Yeah, it's real money. It's nice to make the money. But, if you go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. I mean, you can do that in a week. So my point is, it's still $1,000 an ounce, good for the holders, but the percentage increase gets smaller and smaller as the absolute dollar amount gets larger and larger. So $15,000 sounds like a big number from today's perspective, but as you go to 10, 11, 12, it gets to be a progressively smaller percentage increase, and therefore more likely. You need to see it logarithmically to see it, a less hyperbolic curve. So logarithmically is the right way to think about it, but in dollar terms, the percentage increase gets to be pretty small at those levels. And when I say $15,000 an ounce, I don't think I'm stretching. I mean, could it be 25,000, 40,000? I mean, just take my monetary equivalent. If you use M2, and by the way, when I used M1 and did that math, that's with 40% backing, because historically 40% has been a high level of backing. If you take M2 at 100% backing, you get to 50,000 an ounce in a heartbeat. My numbers, I think, are conservative. They could be much higher. But the thing I would point out is that the Fed dug a hole and they can't get out of it. And I said all along, but certainly, 2014, 2015, et cetera, as they did the taper and then they did the liftoff and then they raised rates and all that. I said the Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates. But I also said they won't be able to do it. And that's exactly what happened in the fourth quarter of 2018. Between October 1st and December 24th, 2018, the stock market dropped 19%. It was 1 point away from a bear market at that stage. And then you had the Christmas Eve massacre. And that's when Jay Powell threw in the towel. He got religion. He said, okay, first he said, we're not going to raise rates anymore. Then he said, we're on pause. Then he said, we're actually going to cut rates. And then 9 months later, he said, we're going to end quantitative tightening, which was reducing the balance, the money supply. And then in September 2019, they started QE4, which is that was before before the recession, before the depression, before the pandemic. They were already in QE4 and cutting rates again. So they can't get out of it. Now it's worse. So they prove that the failure is manifest. They prove that they can't get out of it. And what can they do? By the way, on monetary theory, I mean, you say, what's the secret behind I think it's garbage, by the way, but you say, what's the secret behind it? Well, the secret behind it is if you can issue debt and collect taxes in the money that you print, you can force people to accept the money because they need the money to pay their taxes. And if they don't pay the taxes, they end up in jail. Now you can get extensions or do whatever, but at the end of the day, if you manifestly refuse to pay your taxes, they will come and put you in jail. And the point is, it relies on state power. It's really a neo-fascist concept. It relies on coercion, the point of a gun, jails, and state power to enforce the confidence in money. Now and they say that. I mean, I've read Stephanie Kelton. She's the bright light. I mean, this goes back a long way, but I've met her, read her books and her book, I should say, and her articles. But they're very explicit about that. Now, I think that's completely wrong because there are so many workarounds and so many ways to get out from under that kind of state power. But they do rely on state power at the end of the day. So that's why it has this neo-fascist element. The Fed will not be able to get interest rates to 5% without causing a recession, not to mention the impact on the deficit and a lot of other things. So the Fed can't escape the room. So if inflation stays where it is, the Fed can't get interest rates to a real level without causing a recession, which will sink the stock market. But even if inflation comes down a little bit, that'll be a sign of recession. So you're raising rates into a recession, which will cause a recession. You end up in a recession either way. It's just a question of whether the Fed persists or throws in the towel. Now, we've seen this movie before. What's going on is an exact replay of what happened between 2013 and 2019. May 2013, Bernanke announces the taper. Expectation is they're going to start the taper in September. He chickens out. They start the taper in November 2013. They finish the taper in November 2014. Then here comes Yellen. She's going to raise rates. Take out the word patient from the statement. She doesn't raise rates until December 2015. And then she doesn't raise them again until December 2016. They went a whole year between two 25 basis point rate cuts. And then here comes Powell, and then boom, okay, 25 basis points, boom, 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 gets them up to 2.25, which is where they want it to be, and gets the balance sheet down to about $3.5 trillion. They want to get it down to about $2.5 trillion. But he's got rates about where he wants them. He's got the balance sheet on its way down, and he's normalizing. And what happens? The stock market crashes 20% between October 1st, 2018 and December 24th, 2018. That was the famous Christmas Eve massacre where the stock market fell 3% in one day. But the Fed's still tightening. The Fed tightened like a week before the Christmas Eve massacre. They tightened into the weakness. They were getting very close to crashing the stock market. They took it down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out. Okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE. I forget if it was 8 or 9, whatever. Lost track of QE. He starts QE 8, let's say. And then that takes you into 2020. And here comes the pandemic, and rates go down to 0. And the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen. And it's not clear which, but it's going to be one or the other. They're going to keep tightening and keep tightening and keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. But the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil. They don't build pipelines and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here. The supply chains are getting worse. But these supply chain disruptions didn't start with the war. They didn't even start with the pandemic. They started with Trump's trade war beginning in 2018. I found a very good book on that written by Lorianne LaRocco. And what's interesting about her book is that she finished it in late 2019. So it's almost like a controlled experiment. It was pre-pandemic. It's easy to say that the pandemic disrupted the supply chain, which it did, and the war disrupted the supply chain, which it did. But here we have a very rigorous study of what was happening to supply chains before either one. And the answer is they were a mess. They were a mess back then because of tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That sounds easy because Brazil grows soybeans. Well, guess what? You got to get the ships to Brazilian ports. You got to rearrange all the logistics lanes. That was happening already. Pandemic made it worse. And now the war makes it even worse than that. Yeah, the world is breaking up. We're decoupling. Globalization is over. There'll be a new form of it. It's not the end of world trade, but you're going to see, maybe the Five Eyes, UK, US, Canada, Australia, New Zealand, and friends in Western Europe form a new trading bloc, but exclude China and Russia. It'll be a little bit more like the Cold War. I talked to Paul Volcker about this, but here's what happened in the 70s. Now, it started as cost push inflation. It was the Arab oil embargo in 1973 after the 1973 war, the Israel-Arab war. Then the Arabs threw the embargo on us. The price of oil quadrupled. It went from $3 a barrel to $12 a barrel. It sounds cheap, but that's a 300% increase. And then we had a severe stock market crash and recession in 1974, which at the time was the worst since the Great Depression. We've had worse ones since, but at the time, that was the worst recession since the Great Depression. Then we come out of that, and along comes the Fed, and we went off the gold standard. Nixon had an easy monetary policy in 72. It was a little earlier for his reelection effort, et cetera. So here comes the inflation. But what happened along the way, and then you had another Arab oil, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were double oil shocks. That was supply-driven cost push inflation. But along the way, it morphed into demand pull. It morphed into a demand-driven inflation. And I lived through it. I mean, I was a young, up-and-coming lawyer at Citibank and a senior officer living in New York City. And that was the world where if you wanted anything, new furniture, TV set, vacation, whatever, you ran out, you dropped everything, ran out and did it because the price was going up so fast. So that's instructive in two ways. Number one, it shows that the Fed's always behind the curve. It shows that these things can persist a lot longer than people expect. But in my view, most importantly, because I think things are going to happen more quickly now, it shows inflation morphing from cost push to demand pull, morphing from something on the supply side to a psychological shift on the consumer side. And Volcker crushed it, but at a huge cost. Unemployment was about 11%. He took interest rates to 20%. How does that feel? Mortgagors and student loan holders and others, 20%. You talk about 40% on credit cards in that world. And people forget, well, doesn't inflation, don't you have high growth or whatever, at least, or low unemployment? No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We had 3, 1974, 1980, and 1981, which lasted until 1982. And by the way, people lost confidence in the dollar. In the late 70s, Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now, it was Treasury debt. You had the Treasury credit, but it was denominated in Swiss francs because nobody wanted dollars. That's how bad things were.